When the most relentless corporate Bitcoin advocate doubles down during consolidation, smart money pays attention. His timing looks contrarian, even reckless to traditional analysts. By the end of this video, you will understand exactly why. You will also learn how to adapt the playbook without copying the risk. But first, let me show you what Saylor is really doing beneath the headlines. Welcome to Alpha Markets, where we decode the market and build your wealth. The claim today is bold. In 6 months, Bitcoin could hit $225,000. That is not a promise, just a scenario worth stress testing. Saylor was not born in crypto. He built his reputation in enterprise software and corporate strategy. He founded MicroStrategy in the 1980s and spent decades selling analytics to large organizations. That background matters because it trained him to think in systems, not stories. He learned how institutions budget, how boards decide, and how capital markets reward narratives. His track record is complicated, which makes him useful to study. In the dot-com era, MicroStrategy soared and then collapsed brutally. The drawdown was the kind that ends careers and reputations. Saylor survived it, rebuilt the business, and stayed in the public markets. That scar tissue shaped his later obsession with balance sheets and monetary durability. In the early 2020s, he reframed MicroStrategy as a Bitcoin proxy. He argued that cash was a melting ice cube in an era of monetary expansion. So he shifted corporate reserves into Bitcoin at scale. That move turned him into a hero for some investors. For others, it made him a cautionary tale about concentration risk. His philosophy is simple, and that is why it spreads. He treats Bitcoin as digital property with a fixed supply. He believes scarcity plus global liquidity equals long-term appreciation. He also believes volatility is the admission price for asymmetric upside. His public line is that you do not trade Bitcoin, you accumulate it. What makes him different is the corporate wrapper. Most Bitcoin believers are individuals, funds, or miners. Saylor brought the thesis into boardrooms and debt markets. He used convertible notes and other financing tools to increase exposure. That adds leverage, and leverage changes the entire risk profile. It can magnify gains, but it can also force painful decisions. He also leans heavily on cycle thinking. Historically, Bitcoin rallies in waves, then consolidates, then pushes higher again. After new highs, it often retraces hard before resuming. Late 2025 delivered that script. Bitcoin peaked above $126,000, then pulled back roughly 30% toward $80,000. But here is where things get interesting. Now let us connect that investor mindset to today's tape. Bitcoin is around $95,766. The RSI is near 52.25, which is neutral. Daily ATR is about $2,127, showing meaningful day-to-day movement. Trading volume sits near $23.93 billion, so liquidity is still strong. Data shows that Bitcoin is consolidating versus the S&P 500. Support is near $90,455. Short-term momentum targets cluster around $96,750 to $98,500. That is the battlefield where bulls and bears are currently negotiating price. Saylor's signature win was not a single trade. It was the narrative arbitrage of turning corporate cash into a scarce asset. As spot Bitcoin ETF assets reached around $117 billion by early January 2026, the institutional bid became harder to ignore. Bulls argue that ETF inflows create a steady demand pipe. They also argue that corporate treasuries following Saylor could add another layer of structural buying. Another bullish pillar is whale behavior. Reports point to accumulation of 269,822 Bitcoin, worth about $23.3 billion. Historically, this has meant large players are positioning before expansions. Bulls would counter that whales often buy when retail sentiment is bored. Consolidation can be the quiet phase before the next leg. Analyst voices reinforce the upside narrative. Tom Lee at a Wall Street research shop argues for potential upside to $200,000 or more, citing strong institutional demand. The chief economist at Bitmining forecasts $225,000, driven by regulatory tailwinds. CoinShares expects $120,000 to $170,000 in 2026. Maple Finance expects $175,000 by year-end 2026. But here is what most people miss. Those targets are not just price calls. They are assumptions about liquidity, regulation, and risk appetite. If those inputs change, the same models can spit out very different outcomes. Price targets are stories with math, not math without stories. Now, to be fair, the bear case is not a straw man. Bears counter that momentum is fading. The MACD histogram is around 0.0000, signaling weakening bullish thrust. Bears would argue that neutral RSI plus weakening MACD often precedes a deeper dip. They also point to consolidation below key moving averages and death cross patterns active since late November 2025. Drop a comment. What matters more to you right now, ETF flows or on-chain whale accumulation? I read every comment. Your answer reveals whether you trust institutions or market structure more. It also helps frame your risk tolerance. Bears also focus on levels. If Bitcoin fails to hold $90,455, the next downside area sits near $85,482. And some bears warn about the 200-week EMA near $68,000. That would represent roughly a 25% decline from current levels. James Wynn, Brannigan Barrett, and Coco.NAD all back bearish targets between $64,000 and $68,000. Carol Alexander at the University of Sussex offers a wider range view. She expects $75,000 to $150,000, with $110,000 as a center target for 2026. That is a useful reminder that forecasts can overlap. A bullish year can still include scary drawdowns. A bearish call can still include sharp rallies. And that is when the market revealed the truth. The truth is that Saylor's approach works best when liquidity is rising. It struggles when volatility spikes and financing tightens. According to SEC filings, corporate Bitcoin exposure can be funded in ways that introduce refinancing risk. Investors might consider that the wrapper matters as much as the asset. A company can face margin dynamics even if Bitcoin's long-term thesis remains intact. If this analysis is helping you, hit that like button. It helps more people find this content. Now let us translate this into a retail investor framework. Before we go further, remember that every investment carries risk. Do your own research before making any decisions. Education is the goal here, not a trade signal. The practical lesson is scenario planning. Bulls argue for a path to $110,000 within 6 to 8 weeks, about 19% upside. They cite moderate bullish momentum and the probability framing that technical analysis gives. One view estimates a 70% chance of reaching $95,000 by end of January 2026. If price holds support and breaks resistance, momentum traders may chase. Now, to be fair, bears counter that probabilities can flip quickly. If support breaks, stop losses cascade and volatility expands. ATR already tells you daily ranges are large. That means risk sizing matters more than conviction. Investors might consider mapping their exposure to levels, not headlines. The risk here is treating a target like $225,000 as a schedule. And this is where it gets really interesting. The $225,000 scenario is not crazy, but it needs ingredients. It likely requires continued ETF inflows, corporate treasury adoption, and friendlier regulatory signals. It also needs a return of risk appetite, where investors pay up for scarcity. In that environment, consolidation at 95,000 could look like a base. But there is another way to look at this. A big target can be the market's way of luring leverage back in. If too much leverage piles on, even good news can trigger sell the news. Bears would argue that after a peak above 126,000, the market may need more time. They would also argue that macro shocks can hit crypto harder than equities. So how do you apply the playbook without copying the risk? First, separate the asset from the vehicle. Saylor can use corporate financing tools that retail investors do not need. Second, define your time horizon. 6 months is short in Bitcoin terms, even though it feels long emotionally. Third, watch the levels and the flows together. But there is one more thing you need to understand. Bitcoin is trading as both a macro asset and a reflexive network. When price rises, attention rises, and flows rise. When price falls, narratives flip, and liquidity can vanish. That reflexivity is why both 225,000 and 68,000 can be plausible in different tapes. Your job is not to predict perfectly, but to manage exposure intelligently. Saylor's current outlook remains confident. He frames Bitcoin as the exit from fiat debasement and the entry into digital capital markets. Bulls counter that institutional demand is the most important change versus prior cycles. Bears counter that technical weakness can persist longer than expected. The numbers tell a different story depending on which window you zoom in. And this changes everything for investors. The real edge is humility plus preparation. If Bitcoin reclaims its prior highs and flows accelerate, upside can surprise. If support fails and moving averages compress, downside can shock. Investors might consider keeping a plan for both, rather than marrying one narrative. The Bitcoin 225,000 thesis shows us that markets move on flows, reflexivity, and risk management. Share this with someone who needs to understand Bitcoin targets without getting trapped by them. Drop a comment. Are you bullish or bearish on Bitcoin over the next 6 months? I read every comment. Hit like if this analysis helped and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down spot crypto ETF flows and why they matter for your portfolio.